Okay, everybody. So first and foremost, welcome. Thank you for taking time off to be part of this webinar. I really appreciate you, taking time off your busy schedule from work, from studies, or from the kids, whatever, right? I really appreciate it. So thank you. So today we'll be covering basically talking about identifying the best risk to reward trading setups. But before we can go into that, I'd like to share with you maybe a little bit about myself. My name is Rayner. I blog at or have a website at tradingwithrayner.com. That's where I usually pen down my thoughts on trading. Everything related to trading, it will be on that website. So if you want to connect with me on Facebook, you can get this link over here, facebook.com, Rayner loves you. That's basically another way you can engage with me on social media. So maybe I just share with you briefly a little bit about myself. I'm currently 28 this year. So I've been trading over the last, I would say, 6 to 7 years. So I started off trading just like I would say most of you as a retail trader in my starting days, in my university days. So upon graduation, I was trading for about 2-3 years then, and I knew I wanted a career in proprietary trading because that is what is the closest thing to my goal. Trading, I love trading, so I should get a job in prop trading. So I basically landed a job in proprietary trading. I was there for about a couple of years, 2 years. I was exposed to the different ways to trade the markets, from scalping, doing spreads, day trading, and eventually I moved on into position trading and swing trading. So right now, I moved on from my firm already. I went on to actively trade for myself right now. I manage a private equity fund as well, and in my time, I also reach out to other traders trying to educate them in the world of trading. So that's basically what I do right now. So right now, I'm primarily both a swing and position trader. Position trader, namely trend following. And as for swing trader, I basically also seek to just capture swings in the market, which we'll go into that shortly. So that's a little bit about myself. This is my face. Pardon my big ears, my big face, because I'm a little big by nature. So yeah, so let's talk about what we are going to cover today. Today, the topics, first and foremost, I will share with you why your winning rate don't really matter. Then I'll talk to you about the different types of trading. I'll share with you a little bit about the different types of charts there are in trading. We'll talk about support and resistance. We'll talk about role reversal. Okay, I'm not sure if there's any sound. So I have a friend, he said, Tetsun said there's no sound. So does any of you have no sound, or is my sound perfectly fine? Okay. So Tetsun, I think it's probably error on your side, because I think the rest are hearing me fine. So yep. Okay. So where was I? Alright, we're talking about role reversal, after which I'll share with you a little bit about my pro trader course, and before we end it, we'll do a Q&A session. How does that sound? We will try to get all this content today within an hour, but I can tell you that it's quite a bit of content for today. So we may exceed an hour. So yep, just something to bear in mind. So first and foremost, let's begin. So just give me a show of hand. How many of you agree with me and you think that your winning rate don't matter? Just a show of hand. Do you think that your winning percentage doesn't matter? Or do you think it matters? Any of you agree that your winning rate don't matter? So I have Zheng Yong, he tells me, say, it matters. A few of you say it matters, a few say it don't matter. Yeah, well, I think this is it's a healthy debate. So let's analyze, and let me share with you my own thoughts on why I want to say that, why your winning rate don't matter. So let's look at it. So imagine you maybe you can do this particular scenario with me. 90% of the time, you win $1. It could be, maybe a gamble you have with your friend, whereby 90% of the time you win $1. Feels good, right? Every 100 times you can expect to win 90 times, and you can win $1 each time. And 10% of the time, you lose $20. Aha. So now, clearly, right, the math in front of you shows you that you win more often than you lose. But however, I'm sure you can agree with me, whether in the long run, will you make money? You are. right more often than you're wrong. But the problem is that when you are wrong, you lose a lot more than you win. So the question is now, will you make money in the long run? The answer is no. And this is why I mentioned why your winning rate or why your winning percentage don't matter. So now the question is this: what matters? What matters? And I'm here to tell you today what are the numbers, what are the metrics that really matters. Number one, the first thing that matters is the average size of your wins. What does it mean? It means that when you win, no matter what you're doing, maybe you're betting a horse, maybe you're going to casino to gamble, maybe you're trading or whatever, this applies across throughout speculation. You need to know what is the average size of your wins, meaning every time you win, on average, how much do you win? The next thing you need to know is what is the average size of your loss. This means, every time when you lose, because trust me, when you are speculating, when you are trading, when you are gambling or whatsoever you want to call it, nothing is 100%, right? There is no such thing as a guarantee. There's no such thing as certainty. So when you are dealing with probability, you are dealing with the fact that you will lose. So when you lose, you want to know what is the average size of your loss when you lose. This is the second metric that you want to pay attention to. The third metric is this, right? The third and fourth, you want to know is what is your winning rate and what is your losing rate. This can be, you can take it as your average winning percentage as well as your losing percentage. These four metrics are basically the most important metrics because it's going to give you this important equation. The equation which is known as the expectancy equation. So you plug in all these four numbers, you plug into this equation that you're seeing right now. And if you have a positive expectancy, I want to reach out my hand and congratulate you because you have something that works in the market. Are you with me? Are you with me? Expectancy, this is what you want. You want a positive expectancy in your trading method. And how do you define expectancy? Well, you define expectancy using this formula over here. So let me do a quick math with you to illustrate my point. So how do you do this? Say for example, let's talk about a trading system that you come across. It wins perhaps 55% of the time it wins. Okay? That's your winning rate. Your average winning percentage, you win 55% of the time. How much do you win on average? Let's say on average you win $100. That's your average wins. So you bracket this up and then minus, open another bracket, your losing rate. What is your losing rate? Meaning it's trying to ask you how many percent of the time do you lose? So what you need to do is just take 100% minus 55% and you're going to get 45%. Just very simple arithmetic. Then you multiply by the average size of your loss. Meaning when you lose, on average, how much do you lose? So let's say for example, for simplicity's sake, your average loss, you lose say maybe $80 of the. So right now, you plug in this number into this equation and you have your expectancy. Well, you can do the math and I can tell you it's going to be a positive number. And if you have a positive number after plugging in these four metrics, then what I'm trying to tell you is that your trading method has a positive expectancy. This is it. So often I'm sure, for me personally, I was in my early years of trading, I can tell you that I wish I've come across this simple formula. So I wouldn't have hopped from one trading method to the next, wondering whether it works. Maybe I do in 5-10 trades, doesn't work, I hop on to the next trading method. Because honestly, you need to plug in this formula and you need a minimum of 100 trades. And then you will know whether your trading method has a positive expectancy or not. So, yep, this formula is very important. I just want to share this with you. And I want you to know that you can simply calculate it using a simple calculator. All you need to have is the average size of your wins when you win, the average size of your loss, the winning percentage, and your losing percentage. All these matrix, you can definitely access to it. I mean, if you have a very simple trading journal, you calculate how much you win, how much you lose, how often you win, how often you lose, you can get this expectancy value up. So yep, this is something that I really just wanted to share with you because I think it's so important. Okay, so now that I've shown you how to apply this formula into your trading, right? Let's move on. So let's understand the different types of trading out there. I'm sure you've heard stuff like, like this, for example, day trading. Well, day trading sounds pretty intuitive. It basically means that your trading style revolves around trading within the day itself. You will tend to close your positions, your trading position within the same day. So basically, as a day trader, what you're trying to do is just to trade the intraday volatility of the markets you're trading. So I would say a very popular product to trade for a day trader is, for example, the Forex market, because it's open, I would say, almost 24 hours. So day trading, certain instruments are more favorable for it. Just to share with you an additional thing, if you want to go down another time frame lower than day trading, is what I call scalping. So scalping is basically even a faster pace than day trading. Day trading, you're basically trying to capture the intraday volatility. But when you're scalping, you're just trying to get 1 to 2 ticks out of the market. When price move a little bit, basically that's what you want to do. Just capture that small movement. That's called scalping. And you want to go down even a lower level than scalping is where we go into HFT, high frequency trading, which is usually done by programs, algorithms. It's no longer a manual trader doing it. So basically, day trading, you bring down one level, you go into scalping. Scalping, you bring down another level, you go down into high frequency trading. And when you are doing high frequency trading, you can, your program can trade easily, thousands of times a day. You can even look at this firm called Virtu Financial. They make money practically every day, and they are a high frequency trading firm. So yeah, these are a few different types of trading. And also I want to talk about swing trading. So what is swing trading? So from your understanding, I shared with you earlier that day trading is basically trades that you close within the day. So for swing trading, what you are typically trying to achieve is, let's say, for example, this is an uptrend. So price pulls back. And as a swing trader, what you're typically trying to do is just to capture that one swing in the market, just this portion of the move. Just one swing in the market. That is basically what a swing trader does. You're just capturing one swing. So for a swing trader, typically your positions will be, lasting from a few days to maybe even a few weeks. So that's a lifespan of a swing trader. And now, last but not least, I want to talk to you about position trading. So basically, position trading is, I would say, the longer term type of trading is basically, where trend followers trade on this time frame. So for example, you have a trend like this. So if you're a position trader, say for example, you get long at this retracement over here, you're looking to ride this entire move higher until the trend ends, right? If the trend ends, then a position trader will be looking to get out of the trade. So this is typically what a position trader does. His trade usually varies from, a few days if you do get stopped out, and may even last for even months if the trend is still continuing. So basically, these three different types of trading are basically, have a positive correlation between how long you will hold your trades. So I have a question by Klaus. It asks me, say, can you be swing trading within the day in the lower time frame? Well, swing trading, you can do it on the lower time frame, meaning that you just capture the swing on the lower time frame. Yeah, it's possible as well. But usually for swing trading, the definition is usually traders trading off the 1 hour chart and above. So that's what it means by swing trading. And another question I got is that, hey Rayner, can I be both swing trading and position trading? Yes, you can as well. So what do I mean by that? So if you want to be a swing and position trading, it may go something like this. Right? So for example, you enter down here on the retracement, you want to capture one swing, and you got the swing. Say you take profits, half your profits at this swing high. Then I notice, hey, the trend looks up. Maybe I could ride the position, and trail my stops accordingly. So your remaining half of a position, you can, ride it in anticipation that the trend will continue. So in this way, you are basically a swing trader by, exiting half your profits at a predetermined level, and the other half of your remaining position, you are basically trying to ride to capture the trend. So yep, you can actually be both a swing and position trader. But that's usually more for more advanced traders who have been trading for years, and they're basically know what they're doing. So With that, let's talk about the different types of charts. But let me get a drink of water first. So the different types of charts. Number one, you have is what they call the line chart. Basically lines on your chart, you just see a line. Number two is what we call the bar chart, where you see bar in your charts. And the third one is basically candlestick chart. Trust me, there are more charts. They have Renko chart, they have point and figure chart, but I wouldn't go into any of those. Right? If you want, you can read up on yourself. But I'll say the three most common one is basically the line, the bar, and the candlestick chart. So let's have a look at them. So the line chart is basically what you are seeing right now. You see that there is basically lines on your chart, and you're probably wondering, how does all this line form? So well, according to your trading platform, you have a few options. You can, number one, you can use basically the close of the prices. Number two, you can use the open. Number three, you can use the high. Number four, you can use the low of the prices. So you have the option whether you want to use the closing price, the opening price, the high, or the low of the prices, and that will be formed on your line charts. So what's the good thing about line charts? I would say the good thing about line chart is this, is that support and resistance, right? If you don't understand what that is, right, don't worry, I'll explain that shortly. But the good thing about line chart is that it becomes very easy to identify support and resistance level. It becomes easy to identify what is the trend, because you look at this chart, clearly the trend is down, right? Because you look from left to right, you're seeing lower prices. So a line chart basically allows you to identify, support and resistance clearly, because you can see clearly this area is a resistance as well. It's probably support. So etc. So basically I would say a line chart is good for this purpose. Now let's talk about bar chart. What is a bar chart? So before I show you what is a bar chart, I want you to understand, how do you even read a bar? So for those of you who already know, bear with me for a while, because I'm sure there are a few traders here who may be new to this. So when you look at a bar chart, pay attention to these two things, all right? The open is always on the left. Okay, your open is always on the left. This left thing sticking out is the opening prices. The right thing that is sticking out over here is your closing prices. And the high over here is basically the high of the candle. And the low over here is the low of the candle. So this is how you read a bar chart. Because later I'm going to explain to you what is a candlestick chart, and there is a slight subtle difference, and that you want to bear in mind. So with that, look at this, and this is basically a bar chart. Basically, you saw one bar earlier, and this chart is a cluster of I would say 100, 200 bars combined together to form the same chart. And again, this is basically the same chart as what you saw earlier. The line chart, the trend is still down. But on the bar chart, I would say what is obvious on a bar chart, or what I would say it stands out, is when you start to see these wicks like this, wicks like this, wicks. Wicks is basically telling you rejection of prices. You have wicks over here, wicks over here, wicks over here. So basically on the bar chart, it's easier to see rejection of either higher or lower prices. And now let's talk about candlestick chart. How do you read a candlestick chart? So a candlestick chart is like this. I'll share with you right now. Remember earlier I shared with you the bar chart. I said on the left is the open, but when you come into candlestick chart, you want to notice that if it is a green bar, I would say if it's a bullish bar, or the bullish, or a bar that closes higher, basically your open is over here. It's at the low portion of the bar. This is where price open, and on top over here is where price close. And needless to say, this is the high of the bar, and this is the low. And when you look at this bearish bar over here, this bearish bar basically indicate that price has closed lower. It has closed lower than your open. Your open is at the top over here, and your close is at the bottom. Your high is the same over here, and your low is over here. Because it's basically quite intuitive, right? I'll be honest, when I started reading off this candlestick chart, I was quite confused, about why sometimes the open is on top, why sometimes the close is below. And it's actually very intuitive. If you look at this red bar, it basically tells you that price has closed lower. And for price to close lower, your open has to be higher, am I right? Because there's no way price can close lower if your open is not at the top. And for this bullish bar, for this bar where price close higher, your open has to be at the bottom, because price has to close higher before it can close green. So these are quite intuitive, and I believe you'll figure it out soon enough. So now let's look at a candlestick chart. So basically, again, the same chart, but we amplify it. We put it on with lots of candlesticks, and it basically looks something like this. So you may wonder, Rayner, earlier you saw a bar chart, and now it's a candlestick chart. They basically have the same thing, right? They have their open, they have their close, they have their high, they have their low. So you basically see they are showing the same thing on the chart, but visually it looks different to the eye. I mean, for me personally, I prefer candlestick chart because I can see the green and red bars. I can see like the momentum, the strength of the move. But compared to a bar chart like this you saw earlier, it's not as visible. But again, there is no right or wrong down here. It really depends on your preference. So for me, I like candlestick. I'm comfortable with it, but perhaps for you, you may prefer bar chart. So there's really no right or wrong down here. So yeah, so I got a question by Winkin. Basically, is how do I identify rejection of higher prices? So basically, what I meant by rejection of higher prices is when I saw this wick sticking out. I saw this wick sticking out. This wick sticking out, just basically telling you that prices are being rejected. Yeah, that's why you have this wick on your chart. So that's basically as simple as it is. Okay, so now moving on, let's talk about something called support. I'm sure most of you have probably heard of this term before. Any of you have not heard of this term called support before? Just a show of hand. Okay, great. So I think most of you have actually heard it before. So let's look at it. So I want to share with you is this, right? Support is basically an area. So my emphasis here, the word here is an area where buying is strong enough to prevent further price decline. If price is in an uptrend, you want to buy into support because you want to trade along the path of least resistance. And the thing to know is that support, it does not always hold, right? Don't have the notion that, oh my God, price is coming to support. It has to hold. It's like a steel floorboard whereby, price would bounce off from there. No, please don't even think along the lines. I would rather you to think support as a wooden plank. Let's say, for example, this is a cliff. This is a mountain, right? You have two mountains over here. And you are standing right here on this mountain. And you want to cross over this mountain 1 to mountain 2. You want to make a crossover. So what you want to do is put out this wooden plank to get over to mountain 2. So as you're walking, right, say for example right now you're here, right, the plank is currently your support. It's supporting your weight so that you do not fall off this from this tall height. So what happens if, for example, you start jumping on this plank? You jump, right, with some heavy load on it. What's going to happen? Your plank is going to break, right? So it's the same thing for support. Your support will not always hold. There will be times where the support will break, and when it breaks, it breaks. So do not always, have the notion that support is something that will hold forever. So now, another thing I want to highlight is this. Recall I said support earlier is an area. So let's say, for example, I draw this particular let me redo this. Say for example, price is trading something like this. And then you identify on your chart, okay, I see these highs. This is my resistance. I see this is the lows. Okay, I identify as my support. It would be quite a mistake if you think this resistance over here and this support over here are just simply a single fine line on the sand, right? Because it's not. Recall earlier, I said that support is an area, right? The keyword is an area. It's not just one line on the chart. So why do I say that it's an area? Because there is always the possibility of this happening, right? Price retraces lower, does not come back to test your support, right? Does not come back to test the line that you have drawn, and then it trades higher. So this is what I mean by support is an area. So you want to draw it as an area. Something like this. Now you see this area here is a support area. So this is why I'm emphasizing, right? Do not treat it as a single line on your chart. Similarly for your resistance, right? What could possibly happen is that price trades just above the resistance and then it trades lower. So this is why, your resistance is basically an area as well. So another thing to note is that, another point I want to make out is this. This is important, right? So say, for example, you have this chart over here. And say, let me draw this resistance range I've highlighted, right? Just because price trades away higher, exceed the range by a little bit, right? It does not mean that the resistance is broken, because depending on the context of the market, there is a good possibility, right? Just because it trades above the recent highs, what you can do is just simply comes back into the range again. So always give yourself the enough buffer and the possibility that, price will just jerk out a little, right? Just push up a little and then comes back into the range once more. So this is why I emphasize, do not treat it as a single line on the chart. So again, I've drawn a few examples down here. What is the support? So you can see clearly on this chart, this is the chart of the S&P 500. This is a support area that I've highlighted. Notice that I use two blue lines. I don't use a single line. I use two lines to highlight this area. I use another two lines over here to show you the support area over here. So right now, let's say, for example, price is at 2.12105. If price does retrace lower, you start to tell yourself that, okay, this is an area of support. Anywhere in this area, you could potentially expect a bounce by the markets. But again, I've said also, support does not always hold. Recall earlier the cliff example I shared with you. Sometimes support will break. And when it breaks, you better get out the trade if you are, going long and, and anticipating that price would go higher. So, okay, just a quick example. Another one over here. This support which I've highlighted. These two blue lines is an area of support. So if price does trades lower, the moment it comes into, the first blue line over here, you want to be paying attention to see if this support area will hold up. So this is a very clear example of support breaking, because I don't want to give you false hope and think that it's something that always works. So you can see clearly over here, this is support, test once, test twice, test thrice. The fourth time basically punctured through it. So I've got a good question here by Badri. He asked me, he said, Rayner, so how do you determine whether the support is broken or whether it's only a false breakout? And to be honest, there's no hard and fixed rule, but a general guideline is this. The further price has broke out of support, the further away it breaks, right? It increases the odds that the breakout is real. And likewise, if price just break out and is currently trading somewhere over here, then the breakout isn't confirmed yet. It can only be confirmed after the fact. So the thing is, the further away that price has breached support, right, it's easier to see that it has really broken. But at this juncture where price is trading this black line over here, honestly, you can't tell whether it has broken or not, because like I've said earlier, what it can do is just simply trades back above into the range. So there's no way to tell until the fact is over. And this is why we always have a stop loss in place, because honestly, I can't predict what is going to happen in the markets. So resistance is just the opposite of support. It's an area, again, right? The keyword here, area where selling is strong enough to prevent further price advance. And if price is in a downtrend, you want to sell into resistance. So don't be fooled by this very simple logical line over here, right? Honestly, this is a very powerful principle. What I mean by this is this. Say, for example, this is in a downtrend. And at this juncture here, it says, if price is in a downtrend, you want to sell into resistance. I didn't say buy into support. So in this downtrend, as price trades lower, I wouldn't be longing to support over here, even though we can clearly see that this is support. Why is that? Why is that? It's very simple. You want to be trading along the path of the least resistance. So if price is in the downtrend, you only want to sell into resistance. So this means that if price does retrace higher, I would then look to sell into this resistance because the trend is down. I would ignore all support in a downtrend. So this is a very simple principle, but it's a very powerful one if you follow it closely. And just like support, resistance does not always hold. So I showed you another example here. I used two lines to highlight it. This is basically a resistance area. So if price does trades higher, this is the area to be looking out for. Another one over here I've shown you. So price came into this resistance, consolidated, then it trades lower, then it trades higher, right? Just touching this blue line, just the first blue line over here, then it slumps all the way down. Then what happened next? It rallies all the way back up higher, taking out these highs over here. So at this juncture, if you look at it, oh, price is traded above these highs over here. You think, oh, it's a breakout, no? Higher prices to come. Next thing you know, price then smash down lower once again. So this is why I'll say, don't be too quick to think that the breakout is real just because price took out the previous highs or the previous lows, right? You need more than that. So this is a very clear-cut example of resistance clearly filling in this example. This was the resistance area. Finally, it broke out above it. So, yep. Role reversal. Okay, so before I talk into it, right, let me have a sip of water. So let's talk about role reversal. So one thing to note, right, is that when support is broken, right, when the support area is broken, it tends to act as resistance. And similarly, when your resistance is broken, it tends to act as support. So let me share with you a simple floor and ceiling analogy to illustrate this simple point. Let's say currently you have a house, a 2-story house like this, right? This is the house, this is the first floor, this is the second floor. I'm currently in the first floor, right? This is me. And what am I standing on right now? I'm standing on the support, right? The floor. Support. And what's above me on the first floor is basically what is known as the resistance. So you can picture that this is the support over here, and this is the resistance over my head. So let's see what happened now. I leave the first floor, and there's this a lift. I take the lift up over here. I'm the lift. I come out into the second floor. Right now, I'm standing on the second floor. So right now, when I'm standing on the second floor, what am I standing on? I'm standing on support, right? But this support, previously, it was a resistance when I was on the first floor. Am I right? Because in the first floor over here, recall I said that this was a resistance. It was a ceiling. And when I left the first floor, took the lift up to the second floor, I'm standing right now is on a support. And this support was previously a resistance. So this is what I mean by here. When support is broken, it tends to act as resistance. And similarly, right now on the second floor, I decided to go down to the first floor to get a bag of potato chips. So I took the lift back down, go back into the first floor. And right now on the first floor, above me, what is it? It's a resistance, right? So this is where, when I mentioned, right, when resistance is broken, it tends to act as support. So yep, I hope that helps. Basically, I think you can memorize it, right? When support is broken, it will act as resistance. When resistance is broken, it's going to act as support. So it's basically pretty clear cut down here. So I'll just do a quick explanation once more. On the first floor over here, I'm here on the first floor. Above me is the resistance. So when I go on to the second floor, this previous resistance has now become support. Resistance is broken, it becomes support. So when I'm on this second floor right now, currently I'm standing on the support. I go down to the first floor. This support, right, when broken, becomes resistance. Now on the first floor, this support becomes resistance. So just a very quick run through. So let's look at some charts to illustrate my point. So you see this chart over here. This was a support area, So recall, right? When support is broken, what does it become? When support is broken, what does it become? Beautiful. Clause, beautiful, right? Support, once broken, you retest as resistance. So we got this rejection over here. Then price traded lower. Then clearly in this case, price broke above this resistance over here. Then you retest back the previous resistance. Previous resistance, when resistance is broken, what does it become? Support, exactly. So we got this support one test, two tests, and these three tests over here. Now you get the principle. Beautiful. Another example over here, just to further illustrate my point. This was a resistance, tested once, tested twice. We had this breakout on the third attempt. Price pull back to it. Previous resistance now turns support. Price then trades higher. Come back and retest this close to this support area, but not close enough. Then it bounced higher. Finally, support was broken. Previous support now become resistance here. Price trades lower. Then price retests back to previous resistance. Price then traded lower, retest the previous resistance, trades lower, and yep, you get a message. So, okay. Now you understand this core fundamentals, right? Support, resistance, and this role reversal. Let's do a quick recap. First, you understand, why your winning rate is basically, not important, it's irrelevant, because I've shared with you, other thing that matters is your average wins, your average loss, your winning percentage, as well as your losing percentage. I share with you the different types of trading, share with you the different types of charts you can look at. Different types of trading include day trading, swing trading, position trading. We talk a little bit about scalping. We talk about high frequency trading. Then the different types of charts, we have the line chart, we have the bar chart, we have the candlestick chart. Last but not least, we talk about support and resistance. So now that I've covered the essentials, right? So right now it's about 35 minutes. I think you guys can go for a 5 minutes break. When we come back from the break, I will share with you how you can use support resistance and identify, right, the best risk to reward trading setups. So go for a 5 minutes break. I'll see you in 5 minutes time. And the next topic we'll be touching on is to identify the best risk to reward trading setups. Does that sound good? Okay, I'll see you guys soon. 5 minutes time. Okay, I've got a question by Bedre. I hope I pronounce your name correctly. So Bedre asks, is there any rule say if it touches twice and then bounces, then we need to be cautious as the third time when price approach the support and resistance? So, okay, this is based on my experience, right? My experience is not based on anything scientific or any statistics behind it. But from my experience, the number of times price touches a support area, it increases the likelihood of it breaking the subsequent time. This is from my experience and from what I've noticed in the markets. So I would say, when it price tested support for the fourth time, the fifth time, I would start to, look at it and think, there's a good possibility that it was going to break because, there you can expect to have a cluster of stops below those support area. Okay, boys and girls, I hope most of you are back. Show of hand, to see if you are back in this webinar. Okay, Klaus back, Chris back, Giorgio, all right. Tan is back. Okay, great to see that you're all still around. Okay, someone asked me about pivot points. I don't use pivot points in my trading, so I can't comment much on it. So okay, since most of you are back, let's talk about how do you identify the best risk to reward trading setups. So this is used in conjunction with the earlier knowledge that I've shared with you. So recall earlier I mentioned when price is in a downtrend, you only want to be selling at resistance. Recall it? So this is number one. So when you want to be selling at resistance, so clearly right now what you're looking at is the chart of the New Zealand dollar. That's the daily chart. So I'll plot the resistance out. Let's say, for example, this is a resistance area that I want to pay attention to. This black line, the zone between the black line. So now, since I want to be selling, right? Since I want to be selling right now, where is the best place to sell? So let me ask you, where is the best place to sell on this chart? Would it be over here, number one? Would it be here, number two? Or would it be here, number three? Where is the best place to go short? Okay, so I've seen quite a few different answers. So let me share with you two possibilities, right? I'll share with you if you go short at number two and if you go short at number three. Let's just leave number one out for now because you'll see why shortly. So let's look at it. So here is the resistance area, and I'm sure over here you can conclude that this is probably a minor support. So let me draw that out as well. So let's say you want to get short and price starts retracing higher. Okay, so let's say for example when we want to short, we want to place our stop loss above this resistance area. Am I right? You want to put your stop loss above it. I mean, because there is no point in you going short, say for example here, and then going short here, and then placing your stop loss in the middle of the resistance area. Let's say for example you went short here, this red line here, and you put your stop loss in this resistance zone. It don't really make much of a sense because from what you understand is that the resistance area is a potential area where price may trade lower. So if you put your stop loss in that area, aren't you going to get stopped out of the trade at an area where price could potentially reverse in your favor? So if you ask me, where is a logical place to put your stop is above the resistance area, somewhere here. You want to give it some room above the resistance area. So technically speaking, if you want to go short at this area, let's change the color, shall we? It's a bit hard to see that both are red. Say this green one is the entry, this red one is your stop loss. Okay, so, and you know that this this zone over here is a potential support area where price may bounce. So how do you calculate your risk to reward in this scenario? So what I'll do is, let's get rid of the black line for now, shall we? Since we already identified our zones. So right now, I will highlight out what's my risk. My risk from my entry to this stop loss over here is this much. So let's change this color to red, shall we? Signifying your risk. Now, what is your reward? Well, your reward is that you identify that this area over here, this lows over here, is a potential support where price may bounce off. So this area is your potential area where price may not reverse from. So that would be your profit target, your reward. So let's call this, change this box over here, right? Let's put it in green. So clearly right now, you can see what is your risk to reward. This red box over here is basically your risk. And this green box over here is your reward. And if you were to just calculate it, simple math, it'll tell you that you're basically risking $1 to make 50 cents. Okay, are we clear on it? Because I can calculate, right? The risk is basically you're risking almost 500 pips to make about 250, 260 pips. So basically, you know, it's a risking $1 to make 50 cents. So now that's is for entry number 2. Let's look at the other entry. Let's say we look at entry number 1. So entry number 1 was somewhere here. I mentioned it was near the resistance. Again, we have not adjusted our stop loss. We leave it as it is. Once again, the take profit area is still the same because we know the support area is a potential area where price may bounce. So we shifted our entry towards as close towards the resistance area because we know that at the resistance area is an area where price may potentially bounce off. So it makes sense, right, to get your entry as close to that area as possible. So let's identify what is your risk to reward. So clearly, right now over here, this will be your reward, right? From your entry to the nearest swing low is your reward. And what is your risk? Your risk will be from your entry to your stop loss, right? So this red line over here, it will be your risk. This red box. So can you see how your risk to reward has now skewed so much into your favor based on where you entered your trade? If you're going to enter in the middle of nowhere and place a logical stop because it has to be above a resistance area, you notice that earlier your risk to reward is 1 to 0.5. But right now, if you look at it, what is your risk to reward right now? Let's do a quick calculation. Your entry is here. In terms of stop loss, your stop loss is about 200 pips, close to 200 pips. But from your entry to your profit target is almost close to, I would say, 580, close to 600 pips. So can you see now from earlier, you had a risk to reward of 1 to 0.5. Right now, your risk to reward has skewed to 1 to 3. You have improved that same earlier trade by a total of 600% based on where you entered your trade earlier. So this is how you identify a favorable risk to reward trading setup. This is for a bearish market in a downtrend. So let me just do the opposite. Let's say on this chart, the euro dollar is an up. I'm sorry, this is the euro Aussie. It's an uptrend. Again, the same example. Let's highlight out some key areas. All right, since it's an uptrend, I want to define where is the support area. So right, so this black area, this zone is the support area. I define where is the potential resistance where price may have difficulty breaking. So I've identified this area over here. So now this question is, where is the best risk to reward trading setup on this chart? Is it going to be number 1, number 2, or number 3? Or let's have a special case, number 4. Sorry, number 4. Number 4 is here. Which one? This is, let's change it a little. So let's see where it's 1. Let's put this as 1. This is 1. This is 2. This is 3. And this is 4. You are looking to long this market, so where is the best place to long? 1, 2, 3, or 4? Aha, things getting interesting, right? So we have a Two very different answers. Half of you said 1, half of you said 2. Now, okay, let me share with you my views. I'm not going to say who's right or who's wrong, but I just want to share with you my views. So you clearly define that this is the support area, this is the resistance area. So let me get rid of the black lines right now. I'll leave 1 here and let me leave just 1 here. So now you know, between 2 and 1 is basically a tough choice. Am I right? Number 2 is a good entry. It's quite a good entry if you ask me, because your stop loss, let's say your stop loss will be here. Let's change it to red color. The stop loss will be here. Okay. So from 2, from this area, if you enter at 2, your basically your risk is this much, and your reward is this much, all the way say up to number 4. Say number 4 is your, let's leave number 3 out because no one even voted for it. So number 4 is basically the area where you want to take profit. So you can see, if you entered at 2, basically this is how your risk to reward looks like. It looks something like this. Pretty good risk to reward. I mean, it's easily a 1 to 2.5 risk to reward if you ask me. So this is for entry at number 2. So what if you enter at number 1? How does your risk to reward profile looks like? So let's have a look at it. So if you entered at number 1, your risk to reward profile will look something like this. It's even better. It's like 1 to 5, 1 to 6, 1 to 7. It's even better, right? But here comes the problem. Not a problem. Here comes the issue. If you are looking to long at number 1, it's definitely a favorable risk to reward here, if you ask me. But the only slight issue is this, is you are looking to go long at an area where price have a low probability of reaching. Are you with me? I've said this, right? If you go long at number 1, it is a good location to go long, but it has a very low probability of price reaching that area. Why is that so? Because clearly you're going long below an area where you expect price to bounce from. Right? You're basically going long at an area where price will, chances are, chances are it'll do is it will come into this support area and then it bounce off. And you're queuing your position below this support area over here. This here is where you're looking to get long. There's a good chance you will not get filled. So number 1 is fair enough. It's a good place to go long, but understand that there is a very low possibility of you getting filled on your trades, because you're basically trying to pay as cheap as possible, and that is basically not very likely. So if you ask me, the best place to go long would be number 2. There's a good chance of you getting filled, and it still offers you a favorable risk to reward. Number 1, I wouldn't really go with it because of the fact, as I've mentioned, there is a very low probability of you even getting filled in the first place. So yep, that is my take on it, and this is my take on how you identify favorable risk to reward trading setups. So the gist of the message is this, based on this example we had, is basically, let me get rid of all the additional stuff. It's basically this. When you go long on a chart, or say for example this is an uptrend, you want to go long. You don't want to go long on a random price on the chart. You want to get long at an area where you have favorable risk to reward. So let me share with you where is the worst place to go long. If price is in a range, the worst place to go long is to be over here, over here, over here, etc. Let's not talk about breakouts for now. We are leaving breakouts out for now, right? These 3 areas are the worst place to get long. Where is the best place to get long? It's clearly as low as possible to the range. Let me change it to green color. Right? These are clearly, all these green areas are clearly the best place to get long, because it offers you favorable risk to reward. Because you can just put your stop loss just below this support, this area over here, and it can give you a nice tight stop with a decent risk to reward profile. So this is my take on how you go about identifying better risk to reward trades. Right, compared to a trader who doesn't know what he's doing. He sees a range, he randomly buys somewhere in the range, doesn't know where to put his stop loss, so he usually bails out where? Right, when price trades against him. So usually when he gets stopped out of his trades, it's usually at the lowest of the range where he couldn't tolerate any more drawdown against his account. And this is where smart traders like you go long at the support with your stops just below the support. So this is basically, you taking the money from those losers who doesn't know what they're doing. So this is how you go about identifying the best risk to reward trading setups. Doesn't matter you are doing it in an uptrend, doesn't matter whether you're doing it in a downtrend, the principles are the same. Right? Earlier, recall I shared with you this principle. If price is in an uptrend, you want to go long at support only. And if price is in a downtrend, you only want to go short at resistance only. So these are very simple trading principles, but they are going to be very useful for you throughout your trading career. Okay, so was that useful? Did it help? Okay, great to hear that. Beautiful. So let's just do a quick recap. So basically, the start of the webinar, I shared with you why your winning rate or your winning percentage is basically irrelevant. Right, it's irrelevant because I showed you that you can win plenty of times, but when you lose a lot, basically you will be a losing trader in the long run. So basically, look at the 4 primary matrix. Just a quick run through. Number 1 is your winning percentage. You need to know that. Number 2, you need to know your losing percentage. Number 3, you need to know what is your average win, right? When you make money, how much you win on average. And number 4, how much is your average loss? So these 4 matrix you can compute to your expectancy model, plug in, and you know whether over the long run, whether you have a positive expectancy system. Number 2, I share with you the different types of trading styles: scalping, day trading, position trading, swing trading. We talk about, for example, earlier I shared with you the risk to reward profile, where you look to take profit at the high of the range. Is basically a swing trading method. You're just looking to capture that one swing. That's all. And if you're a position trader, what you'll do is you anticipate the break of the resistance earlier we saw, right? You anticipate the break of the resistance and price to trend higher, and then you trail your stops accordingly. That would be a position trader. So those 2 different trading styles are something to bear in mind. Then I share with you the different types of charts, bar chart, candlestick, etc. And we talk about support and resistance, right? Understand that it's always an area. It's not a single line on your chart, it's an area, and that area can always break. There is always that possibility, so always use a stop loss in place.